Hello, am I audible?
Yes, sir.
Yes, I'm sorry, guys. It's been, I'm new to this Google Meet platform. I have some issues with this thing. Okay, all right. Yeah, yeah. Let's start. Okay, we are already late. We don't want to waste much time. How are you? All of you are doing great now. How was your day? How was the preparation going on?
Going fine,
Monisha?
sir.
Great, 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 great. All right. Let's start. Okay. So, yeah. Yes, now the screen is shared. I think you can read monetary policy there, right?
Yes, sir.
Yes, okay. For the time being, simply please volunteer these things. Why? Because I won't be able to see you people. So just respond to me every time.
Sir, you're not audible.
Yeah, hello. Am I audible now?
Yes, sir, you are.
Yes, yes, yes. I'm sorry, guys. This is my first day in Google Meet. Okay, I'm taking classes in Google Meet for the first time, so I have some confusions regarding the technical side of the things. So please pardon me. Yeah, thank you. Yeah. So let's, without further delay, again and again, let's. It's not like that. Keep it down. Super. Thanks. So let's do it again. Yeah. Yeah. So that is again, again your monetary policy. What do you mean by monetary policy? We all know that, like whenever we are talking about the entire financial structure of a country, the things can be like, we can say like the entire policy structure is okay. What is this? One second. Yep. So when we say the entire policy structure regarding the financial things in a country, the entire policies that is meant to do regarding your financial stuffs can be divided into two broad headings. The first one is monetary policy, and the second one is fiscal policy. Okay. Pardon my vocabulary, my pronunciations. I am a bit worse with those things. Okay. So anyway, my only aim is to make sure that you are able to understand things. Okay. So that's your nothing. What is it? Yeah. Nothing matters regarding your what pronunciation. So the entire policy framework can be divided into monetary policy and fiscal policy. When it comes to monetary policy, it is the domain of, in India, it is the domain of RBI. And when it comes to the fiscal policy, it is the domain of finance ministry. Okay, it's very simple nine class stuff. Okay, so what is micro policy? Sorry, what is monetary policy? It is a macroeconomic policy tool used by the central bank to influence the money supply. That is a key term here. That is used to influence money supply, influence the money supply. I have evaluated some of the papers that you have written by you people, and I should say those are great answers, and you guys are doing it in a great way. Okay, so in that also you have written something regarding the monetary policy committee, right? So this is the domain of RBI. What is the domain of RBI? It is the domain of RBI to influence the money supply. So money supply of an economy to achieve certain macroeconomic goals. It involves the use of monetary instruments. That is another key term, monetary instruments, okay, by the central bank to regulate the availability of credit, the other term, that is credit in market to achieve the ultimate objective of economic policy. What is the ultimate objective of economic policies? It is to ensure that development is happen. Okay, in the current scenario, it should be like inclusive development is the ultimate aim. Inclusive, it should not be not only inclusive, it should be sustainable development. So that's a key goal of every economic policies. Okay, yeah. So now before starting, let's. Is there anybody whose name start with the letter S? Okay, nobody. Then B. Is there somebody whose name start with the letter B? Please unmute and tell your name and tell the answer. Yeah, I see. I told you before itself, as I'm sharing the screen, I won't be able to see the messages. That's why I'm just randomly calling. I won't be even, I can't even see your names too. I can just see the screen. Okay. That's why I'm just calling random, like B, C kind of thing. Is there anybody whose name starts with the letter B? Okay, I think there won't be somebody. Then is there anybody whose name start with the letter C? Okay, it's all right. Then somebody who can answer this question, please unmute yourself and speak.
Sir, Reserve Bank.
Yeah.
Yes, sir.
Yeah, that's
So D is
yes, Delta. That's clean. That is Reserve Bank of India. Is it the duty of Reserve Bank of India? Okay, every time whenever you are doing PYQs, just try to improve on that. How to improve on that? Simple. The answer is option D. That is Reserve Bank of India. Now comes another question: is it the duty of that? Exactly. If it is the duty, how can we say that? To be more precise, it is the duty of MPC. That is Monetary Policy Committee, right? And this is a PYQ, I believe. Not I believe, it is a PYQ. This is a PYQ of 2022. I have attached that too here. Yes, 1 second. Let me see if I can bring that PYQ here. No. So whenever you're learning something, make sure that you do the PYQs from that particular topic also. Okay, I don't have that particular PYQ attached, and it is the duty of MPC to maintain the price stability. Not only price stability, it is the duty of MPC to maintain money supply. Or not only money supply, it is precisely inflation targeting. Okay, we'll talk about it too. Okay, now we'll just leave this question for the time being. So what are the objectives of monetary policy? It's very simple. Like if you can just think for, I told you yesterday in my orientation class that before you learn something, before you read something, just pause for like 2 minutes and think yourself, like what can be, what should be, like what is the objectives of monetary policy. Of course, it is to accelerate the growth of the economy. Growth of economy. What is the growth of economy? For example, in 2020, in 2012, maybe it will be 12 percentage, and in 2050, it should be the aim will be to maximize it to like maybe 30 percentage, right? So this is called economic growth. Okay, so I believe you all know the difference between economic growth and development, right? Now, the second aim of monetary policies are to maintain price stability. So what is price stability? For example, just imagine the situation, that is the price of tomato. Okay, the price of tomato in today, it can be like, I will say 20 rupees. Tomorrow, it's 30 rupees. Day after tomorrow, 40 rupees. Then it is again 20 rupees. So there is some sort of fluctuations happening, right? This kind of fluctuations is not good for an economy. Why it is not good for economy? The fluctuation, the rapid fluctuation in the long term, in the short term, create like it will make the economy to be unpredictable. It will make the economy. I have read some of your answers which have mentioned about uncertainty. Okay, it create uncertainty in the market, right? So in order to avoid those things, the monetary policy can be used, maintaining the price stability. Then of course generating employment. So there is a key takeaway from this session you can just take. So whenever you're writing an answer regarding economy, which related to especially from Indian economy, most of the time you can bring up perspective on employment. Everything has an impact on employment, right? So you can just bring that too, right? Then stabilizing the exchange rate. What do you mean by stabilizing the exchange rate? Okay, suppose the dollar value is equal to 79 rupees today. Tomorrow it should not be like 85. Day after tomorrow it should not be like 200. So this is the forex fluctuation, exchange rate fluctuation. These kinds of things should also be removed or should be avoided. That is one of the goal of monetary policy. Okay, now I have just briefed everything that we have talked up to now. That is, what is monetary policy? It is a macroeconomic policy used by central bank. Okay, it should be clear with you. Most of the time the UPSC have a tendency to trick on you by just changing, by saying monetary policy is a policy used by central government or maybe government of India. They can just tease you with this kind of funny words. Okay, so you should be available, or sorry, your mind should be available in that particular time to think that yes, it is by central bank and not by government of India. Okay, then it is controlled by central bank again to influence money supply and interest rate. Okay, now these are some of the tools. Okay, I have seen in your papers that most of you people have just mentioned about lot of tools used for money supply. Okay, and money supply, quantitative credit controls, everything was mentioned there. Okay, so I'm not going deep into these things. People, you have an extra advantage. You can just pause in between and you can just unmute yourself at any time and you can just ask doubts. Okay, right? I know, like it's I'm just like in a brush. I know why, because I told you yesterday also itself that the knowledge part should be like less than like 20 to 30%. Okay, rest should be your practice. So I am not that kind of a person who always trusts people to stay on for like 2 hours or 3 hours of lectures. So this entire monetary policy, we have to complete it by like in 1 hour of session. Okay, so I'm just rushing in a fast way, but that is not your concern. You can just unmute yourself at any time and you can just speak up. Okay, all right. So we talked about monetary policy, and there are two types of monetary policy. That is expansionary, monetary policy and contractionary monetary policy. Okay, we'll talk about it later. Okay, that is first one is expansionary monetary policy. It is also called accommodative monetary policy. Expansion means something is here, I need to expand it, right? I have to make it bigger and bigger. That is expansion, right? The very meaning of the word itself is expansion. So that is the key thing. That is the expansion. Okay, yeah, the expansionary monetary policy. Okay, that means the monetary policy aims to expand. You just learned like this. This is not the exact definition, but in UPSC, what I have understood is if you can just come up with these kind of jugaad definitions, that is going to help you a lot. Okay, so what is expansionary monetary policy? Expansionary monetary policy is a monetary policy which is intended to expand the liquidity, or not only liquidity, I will say money supply, expand the money supply. That is one of the primary goals of expansionary monetary policy. Okay, so expansionary monetary policy. What can be done? The intention of these kinds of monetary policies, that is to accommodate or that is to expand. So the government will be just planning, or government will be executing things in such a way that it will lead to increased money supply in the economy. Increased money supply in the economy. The money supply should be increased. That is one of the aims of expansionary monetary policy. All right. Now, when we talk about these kind of things, we should be knowing what are the tools. Okay, the first one is decreasing interest rate. So how decreasing interest rate makes it is the money supply to rise? It is very simple. Okay, suppose I'm just telling you, for 1,000 rupees of loan, you have to give me, like, it is a very big amount, but still I will pay. You should pay me 1,100 rupees of interest. Okay, and it just imagine the government has shifted to expansionary monetary policy method. Expansionary monetary policy method. Then what they will do is they will say, like, instead of 100 rupees of monetary policy interest rate, we'll be paying you can charge like 90 rupees. The interest rate will be reduced. So again, so what happens is, sorry guys, yeah. So what happens is the amount that is to be lent, or the loan amount, I will say the loan amount. Okay, and also the expense, right? The expense incurred in this loan process will be very less. Okay, so what happens? This make the borrower to borrow more money, as the interest rates are already low. So this will lead to money supply in economy. This is the condition that happened during the COVID situation. Post-COVID, post-lockdowns, the government have planned to, like, they want to inject more money into the economy, right? So for that, what they have done is they have just decreased the interest rate. They have started to declare moratoriums. They have started to, like, bring up lot of credit schemes. They have started to bring a lot of grant scheme, the things like PLIs, that is production linked incentives, and also the things like DLIs, that is design linked incentive schemes in cases of semiconductor industries and all, and also the famous Atmanirbhar Bharat package. Everything is a sort of expansionary, but it won't comes under monetary, right? Why it won't comes under monetary? Because these things comes under what thing? It's under the sector. It's under the purview of central government, right? So it won't comes under monetary policy. But still, when we want to talk about this expansionary stand, or maybe when we talk about this kind of like expansive beast mode kind of thing, those can also be considered. But things comes, it won't directly comes under the RBI's purview, but comes under the purview of the government, right? Then, yeah, 1 second. So decreasing interest rate. So what happens? Decreasing the interest rate makes it less expensive. What less expensive? The loans less expensive for customers to borrow money, right? Thus increasing money supply in the market. Very simple. Now lowering reserve requirements. What is reserve requirements then? Very simple. I'm just assuming I'm just making a diagram. Yeah, this is a bank. Okay, this is a bank, and person X is coming into the bank. He is depositing like 100 rupees. Okay, and how the banks make profit? Simple. They will be sending this as loans, right? Banks will be providing loans of 100 rupees, rupees 100, right? But there is a small thing, there is a small correction. The correction is whenever bank is receiving some money, that is demand deposit, they have to keep a certain percentage of their deposit with whom they have to keep a certain percentage of the required, like the risk, they have to keep certain percentage of their deposit as with RBI. Okay, they have to keep something with RBI, and they have to keep something with themselves itself, the bank itself. Okay, so we call the reserve that they have to keep from on cash itself in RBI is called CRR. Okay, and when it comes to this thing, that is with themselves, that is they have to create an account and they have to keep the money in that account itself, and that is called SLR. Okay, right? Now if suppose if the government wants to pump more money, that means they have to support more loans, right? If that is not the case, so what they want to do, they have to increase the reserve requirement. For example, let me clear this one. Yeah. Yeah. So if suppose the government want to increase the money supply, so what they want to do? So suppose they want to cut the money supply. So what government can do? Suppose if it is 10% of CRR, okay, and SLR can be like 10% itself. It won't be the case, but I'm just assuming, okay, 10%. And suppose they are receiving a deposit of like 100 rupees. So from here they will be cutting 10%. That means the rest is 90, and again the 10%, rest is 80. That the banks can only lend the rest 80%, right? So suppose if they want to increase, or suppose they want to reduce the money supply, what they have to do? Very simple. 100 rupees are receiving, they will change it to 20%. The CRR should be increased to 20%. Again, the SLR also can be increased to 20%. That is cumulatively 40%. That is 100 minus 40, that is only 60 rupees, right? If they want to increase the money supply, very simple. The 100 rupees is there, right? 100 rupees, the government will reduce the CRR. They reduce it to 5%. Okay, SLR2, they reduced it into 5%. That is cumulatively just 10, like 10%. That is 10% of 100 rupees. That is 10. That is 100 minus 10 is equal to 90 rupees can be lended, right? This can increase the money supply. So this is the way how the government, not the government, the RBI plays using the reserve requirements. Is it clear? Yep. One second. Reserve, lowering the reserve requirement. Suppose if they want to increase the money supply, they can lower the reserve requirements of the bank. People, trust me, this is one of the favorite piece of UPSC. UPSC used to ask questions multiple time from this particular slide itself. I mean, I'm expecting this year also there will be a question from this particular slide. Okay, then purchasing government securities by central banks. Okay, so what is this government securities then? Yeah, the government securities are the securities that is issued by the government of India, right? Okay, on behalf of government of India, it is issued by RBI, right? So something, let me tell you something. Suppose this is an economy. Okay, people, this is an economy. Just imagine this as an economy, and if suppose if I want to put money into this thing, okay, this is, if suppose I want to inject, that is a term that we use. If suppose I want to inject money into this economy, what I have to do, I have to buy something from here. So the goods should be coming out, right? So in return, I will be giving money. We are not talking about export or import this case, but something related to that itself, that only. the goods are coming out. In return, I should be pumping money into this, right? Likewise, so what is this process called? That is, I am buying, right? I'm buying something. Clear? Suppose the same time, hello? Yeah?
Sir, treasury bills are government securities.
Yes, T-bills, these T-bills are. Is there anything? Yeah? Is it clear?
Yes, sir.
Yeah. So actually, in the case of SLR, right? I have mentioned there itself. We talked about CRR and SLR, right? And there is one more thing is there. CRR should be in cash itself. Okay. And this SLR, it can be SL, it can be cash as well as GSECs, that is government securities. This can be in this kind also. Maybe gold also can be in SLR, can be in the form of gold also. Okay. Yes. Okay. All right. So suppose this is the economy. Back to the story. Suppose this is the economy. What if I have to, like, withdraw money? I want to remove money from this economy. Very simple. I have to sell them something, right? I'm just selling them goods. Okay. I'm just selling them goods. In return, the money will be coming out, right? Right. So this thing is applicable in the case of this monetary policy, like the RBI's policy in controlling the money supply also. Suppose just imagine this is the economy. Okay. Okay. This is the economy and RBI. Okay. RBI, there are GSECs. Instead of products, this is the product. That is GSEC. That is government security. Okay. The government security and the government, suppose if you want to inject money into the economy, what you have to do? The RBI have to buy, right? When RBI buy GSEC, what will happen? In return, RBI will be pumping money, right? The money is going in. The money is going in and the GSECs are coming out. So the buying process, inject money. Similarly, if they want to reduce the money supply is very high. When money supply is high, what happens? That it is automatically, it is also known as inflation. So what if the inflation is high? We want to remove that money from the economy. So what they have to do? Very simple. The GSECs are there, right? Do one thing, just induce GSECs. I mean, make compulsion over the commercial banks to buy GSECs from us. Who is us? From RBI, right? So when they sell GSEC to the economy, what they have to come out from economy? They have to pump out the money. Why? In order to buy something, that is, we are selling something into the economy. So the money has to come out from the economy in the name of payments or something like that. So the money is coming out. So what happens? The money supply will be reduced. Clear? In this case, the money supply will be increased, and this case, money supply will be decreased. Okay. So if you guys are asking me, what is, if you are asking me like only one thing that you are ready to learn from today's class, I will ask you to learn this thing, because this is going to give you definite question in this year's paper also. Every year the questions will be from this particular topic. Okay. Yeah. All right. Any doubts? Until up to here, any doubts?
Sir, I have doubt about government securities. Like, what are those?
Okay, well, government securities, right? Government securities are like, we can, for the time being, we'll say like it's a T-bill, treasury bills. The government issues securities, that is bond. Just imagine, that is bond. It can be certain kind of things, but just for the time being, just imagine this as a bond. This is a bond where I'm just asking to RBI, like, the bond of, for example, suppose 10 lakhs. Okay, T-bill. I will talk about T-bill. This is a T-bill, and I will say instead of 10 lakh, it is better if we can just 1 second. Okay, 100 rupee. Yeah, 100 rupee bond is this. So the government is selling it on behalf. RBI will be selling it for the government. Okay, So these bills are kind of a promissory note. Like they will be written that in like after 91 days, they will purchase it back. Sometimes they won't be, sometimes they will write, sometimes they won't write. There are many kind of government securities. Okay, so that is the thing. How they will buy, for example, suppose the rate of the bond is 100 rupee. Okay, most of the time this will be zero coupon bond. Zero coupon bond. Okay, the zero coupon, the name, the coupon, right? The coupon is equal to interest. Coupon term can be is equal to interest. So what happened? What is it? Zero interest bond. So why you are buying it? Very simple. 100 rupee. Okay, instead of 100 rupee, okay, I will discount it. I will say 10% discount. That is, when you buy government security from RBI, okay, you have to pay 90 rupees. Okay, and when you redeem, okay, when the maturity reaches, what you can do, you can just take the bond and go to this RBI and say, okay, my maturity have come. Then what they will do, they will give you 100 rupee back. This is how the government bonds work. There are several kinds of bond. Yeah.
Yes.
Yeah. Okay. Now, as we told in the beginning, we talked about expansionary monetary policy, and now it is contractionary monetary policy. Very simple. Initial case, we have to increase money supply. In this case, we have to pump out, or we want to reduce money supply. Right? So what you have to do? Very simple. What all things you have done to increase the money supply? You remember that, right? Just do the opposite. It will lead to decreasing money supply. Look at here. First thing, initially we talked, right? Like here we talk decreasing interest rate. Here we say raising interest rate. We need to increase the interest rate. What happens when the loans become more expensive for the customer? They will stop buying it. Suppose what if I'm just asking you, like 10,000 is your EMI. I'm telling you, you have to give me it's not a case, 20% of interest rate. So it will block you from taking loans, right? So this is the way. One of the way is to raise the interest rate. Okay, then increasing the reserve requirements of the bank. The case we have discussed in the example of bank, that is 100 rupees coming. Okay, initial 10% was the CRR. Initial 10% was the CRR. Then you can supposed to lend 90 rupees. But I increased the CRR to 20%. Now what happened? 20% CRR. So you have to keep 20% aside, and rest only 80% can be lent. Dekho, here when we increase the reserve requirements from 10% to 20%, it decreased. Let's see, it decreased the money supply. Clear? So that's what I'm discussing in the second point. Okay, sorry, 1 second. Definitely selling government bond. Again, that economy, the story that we are talked about, that is we are just selling, right? So when we sell something, okay, we are selling government bonds, we sold it, okay, we sold it, the money has to come out. So what they do, the RBI will catch those money, they will reserve it. They will keep it aside without getting into the economy. Clear? And it is this one, the contractionary monetary policy is aimed at reducing the inflation. Okay, yes, any doubts?
So why it is known as a hawkish stance?
Hawkish stance, very good question. What is the opposite of it? You know what is a hawk? Hawk. Anybody? It's a kind of a bird, you know, like eagle kind of bird. Okay.
Yes, sir. Yes.
So, hello. Yeah, eagle kind of bird. You know how that is catching its prey? Okay, you just imagine an eagle catching a fish from a pond. Okay, that is same. Like that is same with this contractionary monetary policy. Just imagine the fish as the, like, like the fish as the money, and hawk as RBI. The RBI hawk is coming and catching the like money fish and just pumping up. Means they are just taking the fish from the pond. That's why it is called hawkish stance. Like that's a simple. Is it clear?
So in relate, we can say that when the inflation is coming, then it's just like a hawk. The RBI is coming and just take off.
You know that bear market and bull market, right? Bear and bull. Have you heard of it? In economy, it's very interesting. They have a lot of animals names also. You know what is why that is called? Can you see me, people? Can you see me? Is I'm
Yes, sir, we
there
can
in the
see.
screen?
Yes, sir, you're
Okay.
visible.
So I'll be just showing my hands, and also you should see that action song. This is going to be an action song. That's why I asked. Okay. So you know how a bear attack, right? It will just slap you every time. It's got a very powerful hands, and the nails are very strong. Okay, so what they do, they just slap, right? How they slap? They're just taking things downwards. They're slapping downwards, right? Look at here. Look at my hand movement. It is doing downwards. When and my economy, or when a share market is going downwards, that is when a red candle is there, or when there is a reddish. I mean, when there is going down, the growth is going down. That is called bear. Why? The bear is attacking always downwards. And how a bull attacks you might have seen like bulls attacking each other. They will just do like this, huh? This thing, they just pull it like that. So that is called bull market. That's why that got the bear and bull things. Okay. Similarly, the hawk. I think hawk is that USA is some bird or something like that. And those are the people who are very good at naming things. I think things are clear, right?
Yes, sir.
And people, this is very important, as you have mentioned about these things. In exam hall, you are supposed to do these kind of guesses, okay? You are supposed to take these kind of guesses, especially in prelims. There will be some questions definitely for you to think like this. Okay, you won't be learning like you won't be knowing that before, but at the point of time, you have to think, you have to read, you have to imagine, you have to visualize things, and you have to present it. Okay, yeah. Now monetary policy in India. In India, the Reserve Bank of India act everything need a statutory backing, right? So it is the Reserve Bank of India Act 1934 that explicitly mandates the Reserve Bank of India, okay, which is the responsibility of formulating monetary policy. Okay, the process of monetary policy in India underwent a paradigm shift in year 20. No need. I can, if you want, I can share this link with you. Sorry, the slide with you. Okay, you can just read it. I don't have to explain these kind of things to you. So just imagine, this is the only thing I have to talk to you. Okay, for 2016, what was the single responsibility of RBI? Right. So you just look at here. I want to. Yeah. Sorry. Yeah, it was before 2016. It was the duty of RBI to singularly to make this monetary policy recommendation, but later a technical committee was developed. Okay, right now, flexible targetation. I know that. What is the inflation target in India? Somebody please tell me. What is the inflation target in India?
4 plus or minus 2.
Okay, that is, there should be minimum 2%, right? Maximum how much? 6%.
6%.
Exactly. What is the optimum? That is 4%. Okay. So I'm just giving you a homework. Okay. Please tell me what is the current inflation rate. If somebody knows now, just disclose. No, don't need to. You don't have to do it now. We'll do anything. You just will in next class we'll discuss about this. Okay. Just tell me what is the current inflation rate. Okay. Okay. Now just coming back, monetary policy and inflation in India. There are two kinds of inflation targeting. That is flexible inflation targeting and fixed inflation targeting. Which one India follows? India follows the flexible one. Okay. Yeah. In 2015, the RBI and center means central government entered into a monetary framework agreement that stipulated a primary growth of ensuring price stability while keeping meet the objectives of growth. This is the two criteria. What are things? The first thing is equal to price stability. These are the words that you should be using in your main sentences, and most of them are using it. It's very good. Okay. So price stability. Okay. And second objective is ensure growth. Okay. So there should be a growth and there should be a balance between growth and price stability. Okay, so amended in 2016 to establish this MPC. Okay, consultation with RBI every once year. This is a keyword. Okay, this can be a possible question. Sorry. One second. Okay, this can be a possible question. That is, once in every 5 years, the inflation targets are revised. The question the RBI will ask once in 3 years. Mark my words, you will see these kind of things in your question paper. RBI will ask once in 3 years. It is actually once in 5 years. Okay. Then what is headline consumer price inflation? Okay, what is the difference between headline and core inflation? Anybody? Okay, please do Google homework. Okay, guys, let me tell you something. A great way of learning things. If instead of learning something isolatedly, you learn it in a different way. For example, if you're a sociology optional student, whenever you are talking about stratification, you try to learn in such a way that what is the difference of theories of stratification by Marx as well as Weber. Like this, whenever you're learning something in every chapter, most of the subject, we'll see something opposite to it. Just learn about that also. Like to learn by using differentiations. What is the difference between this and that? What is the difference between the alluvial plains or plains created by Ganges River and Brahmaputra River? Like that, you can just compare it and study. It will be good. Okay. And your first homework is what is the current inflation rate. Second homework is what is the difference between headline inflation and core inflation. Okay. I'm expecting you to answer me these questions tomorrow. Okay. All right. And people, and that is going to be your main prelims. Once again, yeah. These all are will be coming for your prelims examinations. Okay. So then pros of flexible inflation targeting. Very simple. Rising price create uncertainty and adversely affect savings and investment. By keeping inflation in check, it aims to bring more stability, predictability, transparency. Okay, usual way forward stuffs. Okay, I don't want to relate. You can just read it and understand yourself. I don't have to talk much about this thing. Okay, I told you, right? There will be some words in your prelims paper that you have to, decipher the meaning, write down. That is one of a kind is this one. That is tight policy stance, tight policy. Okay, I like that. These are all the things you can just visualize and just understand what it can be. Okay, then this is a PYQ. Yep, this is a PYQ. There was a question regarding the Monetary Policy Committee in India, and the question was this one. This was they just made it wrong. Instead of 6 members, they wrote it as 12 members. Okay, so from again, if they want to ask a question, they will be changing some other particular facts. Okay, so maybe they will say the idea to set up MSC was mooted by an RBI committee, appointed committee, Urjit Patel committee. The chances of they bringing this committee is very less, but still just understand, and you can, if they are asking for the mains question, you can just introduce your answer by using this kind of thing. It was an idea mooted by an RBI appointed Urjit Patel committee. Okay, you don't need this one. These things are not needed. Okay, 6-member committee. It's already asked. Major provisions. What are the major provisions of Monetary Policy Committee? They have to meet at least 4 times a year. Why 4 times a year? Every 3 months they do some like analysis, quarterly analysis, right? So simple. So 12 divided by 3, that is 4. Okay, that is 3 is equal to 1 quarter, right? So that is it. So that's how this days came, 4 times a year. Okay, the members of MPC shall not hold office for a period of 4 years and shall not be eligible for another question. Can be if they want to, if UPSC want to make a question that is economy plus polity, then they will be coming up these kinds of wording. That is whether they are eligible for reappointment. You should be knowing that they are not eligible for reappointment. The quorum, the chances are they are not going to ask this kind of thing. And this can be a question. That is, RBI governor will have a casting vote in case of a tie. Okay, you should remember it. That have a casting vote, not a normal vote. Okay, all right. Then credit control techniques, as I told you before, while I was checking your papers, I can see these things. Like, repeatedly I was able to track these things in everybody's paper. I think the people who have the faculty who have delivered you economic lectures have like made it in a great way. So I think you are familiar with these kind of things. Okay. So credit control, two kinds of credit control. One quantitative, the other qualitative. What is the difference? Quantitative, they can be measured in numbers, right? In sociology optional also, there is something called qualitative versus quantitative kind of things, data. Okay. So these are numbers, right? Everything is numbers and percentage. That is like 25 BPS and 25 percentage, 10 percentage, 4 percentage, 13 percentage kind of things. Okay. So we'll just briefly understand what all things are these. Okay. Yeah. So first one, reserve requirement. I told you before itself. We talked about CRR. Remember, you are aware about it. You are present in the class, so you should be able to understand this one. You can just go through this. You can be able to understand this thing. Okay. So this is the things that you are talking about before itself. Before I told you about the CRR, right? So now then SLR person. I told you this about SLR also. I told you, right, the CRR should be in cash. Before also I told, whenever you're learning something, try to differentiate what is the difference between SLR and CRR. If you can do it, you will be very thorough with the paper. So SLR, what is SLR? SLR is the percentage of net demand and time liabilities, or that the scheduled commercial bank has to keep with itself. That is a key word, keep with itself, in the form of, it can be in the form of cash, it can be in the form of gold, it can be in the form of SLR security. I told you, right, they can keep securities such as government bonds, treasury bills, and other instruments notified by RBI. Okay, or any combination of the both. Okay, I don't want to waste my time on reading these things for you. I think you all are matured enough to read yourself and understand things. I will just explain the technical stuffs. Okay, now comes the liquidity adjustment facilities. What is liquidity adjustment facility? What do you mean by liquidity? Okay, liquidity is very simple. The degree, or how easily I can just convert a X commodity into cash. Okay, and the most liquid asset in the world is nothing but currency, and inside that, dollar is the most liquid asset. Okay, clear, I guess. Now liquidity adjustment facilities, what is the term itself like term itself indicating? Just read the term, you will be able to decipher the meaning from the term itself. There is something called liquidity, and there is some adjustments are happening, and there is a facility, that is there are some options, right? So what it is, suppose the story goes like, the banks ran out of liquidity. That means the banks ran out currency. There are no currency to do their daily activities. What they can do, they can avail some facility, right? They can avail some facility to make the adjustments to bring more liquidity. That is called liquidity adjustment facility. Before concluding it, how they can bring the adjustment, from where they can bring the liquidity, it's none other than our incredible superhero, that is RBI. RBI gives whom? The banks. Which bank? Scheduled banks. What are scheduled banks? The banks that comes in the second schedule of the RBI Act. Okay. So liquidity adjustment facilities allow banks to borrow money from the RBI. I told you, through repurchase agreements, repos, or make loans to RBI through reverse repo agreement. Okay, it is aimed to aid banks in adjusting the day-to-day mismatches in liquidity. Okay, so basically there is two instruments, that are repo rate and reverse repo rate. Repo rate is the rate of interest at which RBI provides short-term loans to scheduled commercial banks. This should be in your note. Okay, repurchase agreement and repo rate. Repo rate is the rate of interest at which the RBI provides short-term loans to scheduled commercial banks. Okay, against securities. And regarding the reverse repo rate is the rate of interest at which RBI borrows funds from the scheduled commercial bank. And you should be knowing one more thing. Okay, it's like there is another thing also. Suppose the commercial banks have extra money with them. Suppose the commercial banks have some extra money with them, they can park that too with RBI for interest. That's also through reverse repo. Okay, yep. So open market operation, open. This is the market. This is the market. Just open it and do some cesarean. That is operation. Okay. So just kidding, no offense. Open market operations. Open market operations refers to buying and selling of government securities. Buying and selling of government security. I told you, economy as an assumed economy, buying, selling, money pumping, money going out, injection, right, anesthesia, etc. Right. So open market operation refers to the buying and selling of government securities by RBI to regulate the short-term money supply. That's a key word. That is short-term money supply. If RBI want to induce liquidity, okay, the term can be a bit confusing, but induce liquidity simply if they want to infuse money into the economy, right? Or more funds in the system, it will buy government securities and inject fund into the system. On the other hand, if RBI want to curb the amount of money in the system, suppose there is a lot of money inside this one, they have to remove it from here, it will sell the government security to the banks, thereby reducing the amount of cash that banks have. Okay? All right. Yes, I think yeah, we'll just finish this also though, so the quantitative will be done. So market stabilization scheme, before reading anything, just take the keywords. That is, there is a scheme, right, which is meant for stabilization. To stabilize what? To stabilize the market. So that means the market is fluctuating, there is a scheme to make it stable, right? So you should be assuming things like this, then you have to read, then you can easily understand things. That is, market stabilization scheme refers to intervention by RBI. So who is stabilizing this market? That is stabilized by RBI. Okay, to withdraw excess liquidity by selling government securities in the economy. Same with the open market operation kind of thing, where we say like it's a selling thing. Okay, under it, RBI sells government bonds on a general basis depending upon the volume of excess. No need to read. Depending upon no. You don't have to read. Just know about this thing. This is enough. This withdrawal of excess liquidity is called sterilization. What is sterilization? It is a PYQ, I will say. 1 second. Yeah. Sterilization is a PYQ. Yeah. Sterilization is a PYQ. What is sterilization? Simple, withdrawal of excess liquidity. There is excess of liquidity, this much of liquidity. So they are taking away this much of liquidity. Okay. So what happened? So this much area become vacuum. The liquidity was sterilized. Okay. Yes. Okay. The securities issued under the MSS are basically government bonds and are called market stabilization bonds. That what is, suppose there will be a question, market stabilization bond. How to think? Very simple. There is a bond which are meant to stabilize the market. So stabilize the market. Like this, you have to frame sentences. So you have to brainstorm, bring things, and you have to create ideas like this only. Okay. So with this, our quantitative tools are done. Yes. Yeah. 1 second. Good morning, people. How was your sleep? How was the sleep?
So we were not sleeping.
Yeah, that's cool. How was the class? Is it any doubts? Is this the topics that you have already done with your self preparation, or like how is it?
So there were new things also. It was really good, sir.
So you understood? Are you able to follow? I was very fast.
No, sir. It was absolutely fine. Like
Just
this.
give me the feedback, okay? So I can just improve upon every time.
Sir, for me, sir, a bit you were fast.
Okay.
But sir, overall the class was good, sir. Like
So
new
just do
concepts were
one thing.
also introduced. So
Do one thing. Whenever you're feeling like I'm going fast, you can just pause me, okay? You can just tell me, sir, please go fast. My assumption was I was checking your paper, some of your papers I was checking. So I go to see that you people are already covering this kind of thing, and I'm that guy who don't want to waste the people's time, okay? So that's why I don't want to go deep into things, because I felt like you people already know the concepts. That's the problem. Just pause, everybody. I'm ready to explain things again and again. I don't have any issues in explaining things, okay? So you can just post me in the middle of lectures and just you can ask me the questions. Okay, next day onwards. Yeah.
Sir, can we contact you like personally for any doubt if we like occur in when we are self studying? Like,
Do one thing. You can just text me. The calling, maybe I won't be able to take your call every time. Like
okay, sir. Okay,
yeah,
sir.
you can
Okay,
just text me, man. No problem. We'll see. See,
okay,
I'm
sir.
not that kind of very, big, very tight schedule guy. Okay, you can just text me, and often we can also have calls also. No worries. Ma'am,
Okay,
you
sir.
can just
Thank you.
give them my numbers, okay? If they are asking, if anybody want my number. Yeah. Anything else? Shall we wind up? Find up the day.
Sir,
Yeah. Hello.
good evening, sir.
Yeah. Good evening. Who is speaking? Yeah,
I
Bhumika.
think,
Tell me.
sir, these notes enough for both prelims and mains for economy.
Sorry, I don't understand you. I was not able to follow.
These notes of economy is enough for both prelims and mains, sir.
Okay, you're asking whether the notes that I'm giving you is enough for your economics, prelims, and mains, huh?
Yes, sir.
Okay, do one thing. I will recommend one book. Okay, so my idea is very simple, and it's been preached by a lot of toppers. Okay, it's not a great or fresh idea. It's very small and very simple idea. One book for one subject, right? So if you're studying Lakshmikant for polity, that's only enough. Similarly, economy, there should be one book, I'll say. And my book was Nitin Singhania. Nitin Singhania is economy. That's perfect. Any editions will work, like latest one or two. Like I think it's currently fifth editions is printed. Fifth or sixth is already in the market. If you're buying it from, you can just get the new edition. If you already have that, whichever edition is with you, it's fine. You can just have that book, Nitin Singhania's Indian Economy. That's a great book, I will say.
Okay.
Yeah. Okay. Ma'am, can we wrap the session?
Yes, sir, we can.
Yes, thank you. Thank you, people. We'll see you in the PYQ analysis.
Thank you, sir. Thank you,
Thanks.
sir.
Thank you, sir.
Thank you, sir.
देवी जी